All right, everyone, let's go ahead and get started. Please do keep in mind that all audio has been muted, and if you do have a raised hand, please do type a question into the chat boxes. I don't necessarily address those individually, so feel free to type in any question that you have, and we'll get it addressed. Just as an FYI, this isn't going to be the longest of all webinars that we've had. I just want to kind of make sure we go over a high level of understanding kind of what crowdfunding is, why you might want to look into it, and some of the potential issues at hand with doing it through an IRA. So with that said, let's go ahead and get started. My name is Alex Perny. I've been doing strictly alternative investing and self-directed IRAs since 2012. If you have any questions following this presentation, feel free to give me a call at the number listed there, or you can certainly feel free to email me as well. If you would like a copy of the handouts, let me just attach them real quick to this presentation. Alrighty, if you would like a copy of the slides, I have attached them as a handout to this presentation, or you can feel free to email me afterwards and I can certainly shoot those over to you in an email. Now, before we get too far into this, we always do need to make sure we explain kind of who Advanta is and what we are all about here. We are proud to say that we've been in business for now 20 years. Back in 2003 in November, we got our start, and we have only been doing alternative assets within retirement plans since then. So we have never been we've never changed our trajectory. The only thing we have done is strictly just been alternative retirements, as our basis of knowledge is and will continue to be for the foreseeable future. We have a little bit over 1 billion assets under administration currently, and we have over 9,000 active clients on our platform. So we've seen basically anything that people have to throw at us when it comes to the alternative space. So everything from real estate to crowdfunding, to private stock, to limited partnerships, to all sorts of interesting alternatives. We've seen almost everything. So if you do have any questions or you're interested in doing something like this, know that we do have a good basis of knowledge and we can certainly help to answer any questions as well. Now, for some people that aren't necessarily familiar with what self-directed IRAs are, it's always important to note that just because you are maybe doing something in a slightly alternative method to your more traditional finance, you're not giving up any of the normal protections and assurances that you're used to. Any cash that's deposited in Advanta accounts is fully FDIC insured up to applicable limits. And also something that we're very proud of is that we offer dedicated account management to any client that comes in. So whether you are looking to invest $1 million in a certain real estate deal, or you're looking to invest maybe $5,000, $10,000, $15,000 into a couple different crowdfunded deals, we always offer dedicated account management with a singular account manager assigned to any and every client that opens an account here at Advanta. Again, also important to understand what we do and don't do. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A few key takeaways that I'd like people to leave here today are some of the different types of crowdfunded investment structures, some rules related to IRA and crowdfunding investing, and what inherently some of the tax benefits and issues might arise from doing these types of investments through IRAs. We'll certainly kind of dive into a few different topics at hand with regard to things that go this, but again, it's a broad topical matter. These are kind of things I'd like to focus on here today with you. Now, to kind of start out, we always need to kind of set a baseline, especially when speaking to things that maybe are a little bit more of a in the door type of investment for self-directed investors, is understanding what exactly a self-directed retirement account is. These types of retirement plans give account owners complete control over their retirement funds and investing decisions, meaning that you're not beholden to just what is listed on our platform. If you go out and find a particular crowdfunding platform or some type of platform you'd like to invest your IRA funds in, so long as that investment provider is willing to accept IRA funds, we can typically make that investment work underneath the umbrella of the IRA, meaning that you're not having to pay taxes and penalties for taking those funds out of the retirement plan. You can actually do investment directly through the retirement plan itself, which is incredibly powerful when you think about how bad you would get hammered with taxes and having to take this out early. You can actually utilize your retirement plan funds to create a greater degree of diversity by investing in alternative assets or things that are outside a traded stock market. Now, these types of investments inherently are outside of the stock market. So things like different geopolitical factors or different inflationary markers might not have as much of an effect on the price point or the returns of these types of investments. However, these investments do carry a lot of other different types of risks. It's important to understand and be very forward thinking when it comes to understanding what the risks are. Just because you're investing outside of the stock market doesn't mean that you eliminate all of your risk. You take on a different set of risk profiles, and it's important for you as the client to understand where your propensity for taking on those starts and where it stops. So again, understanding kind of what the responsibilities are of the client and what types of benefits this offers is key to doing this effectively. And again, with stock market and other different types of asset classes, different types of retirement and structures. So being able to do that through this, again, is very important. Now, a lot of people tend to ask me the question of why isn't this more well known? You know, after you've gotten your first taste of self-direction, one might think, hey, why doesn't everyone do this? And it's simply an economy of scale issue. You've been able to do this type of investing. Granted, crowdfunding investing really only came about in about 2000, I want to say 2008 was when the Jobs Act was passed, but, or sorry, 2013 is when the Jobs Act was passed. So it's important to understand, while yes, this type of investing might be new to IRAs, specifically with crowdfunding of the Regulation A of the Jobs Act, doing alternative investing through retirement plans is not new in any form or function. You've been able to do alternative assets, meaning things outside stocks, bonds, and mutual funds, since 1975. When the IRS wrote in the codes to actually create retirement plans, such as IRAs and 401ks, they did it through a function of a bill called ERISA, or the Employee Retirement Income Securities Act of 1974. That created IRAs back in the 70s, and they gave us very few regulations as to what you could and couldn't invest in. You can't buy collectibles, you can't buy a life insurance policy, and there's certain people you cannot directly deal with. Past that, they left it up to the custodians to figure it out amongst themselves as to what they would or wouldn't allow their clients to hold. So naturally, banks and brokerages gravitated towards selling investments that they already had, CDs, stocks, bonds, mutual funds, T-bills, those kind of things, to their IRA clients. Doing any type of alternative assets such as real estate, debt, anything else you can come up with involves a lot more manpower, and there's not really a big function for these people to make money on it because they're not selling the investments to the clients. So inherently, the market for this kind of stuff is significantly smaller. Information age being what it is, more and more people are getting into alternatives that are out there and how to create diversity through their retirement plans. So it's getting a lot more eyes. The industry is growing very rapidly. But again, to use the example, if you went to lunch at McDonald's, they're not going to tell you that there's a pizza shop next door. It's kind of the mentality that this type of finance has had for a very long time. However, again, just remember that IRS regulations have a very broad range of investments, but not every IRA custodian is required to hold each one. For example, if you go to a Charles Schwab and say, hey, I'd like to invest in this crowdfunding platform with my IRA, they may have a couple for crowdfunding platforms on their crowdfunding investments on their platform, but it's probably going to be very few and far between. If you really want to get out there and dig down and invest in some of the smaller ones, or even some of the larger ones that simply aren't listed on one of these exchange platforms, you have to have a custodian like Advanta to be able to hold that. And again, just understanding kind of where we play into all of this and how these investments are found is, again, very important for you as the ultimate investor. Now, we're going to spend a little bit of time on this slide. For those of you that are just listening in and not looking at the video portion of this, these are the different types of self-directed retirement plans. And for something as simple as this, there tends to be a good amount of confusion as to what type of plan you have to use for a specific investment. And the easy way to remember it is there is no specific type of plan to use for a specific type of investment. I don't know where this paradigm came in that you have to have a Roth IRA to do any type of investing. While yes, Roth IRAs are fantastic, they offer a great tax benefit in that you pay zero taxes in retirement, they're not necessarily the best fit for everyone. Getting money into a Roth IRA can be a little bit problematic in that you have to pay your taxes up front. You get no tax deduction for adding money in. There's much fewer Roth options for employer plans, such as governmental 457s, 401ks, 403bs, TS plans. There's much fewer Roth options out there for people in higher contribution limit plans to be able to get money into Roth accounts. So therefore, the amount of the population that has Roth accounts is significantly smaller, and you are certainly by no means precluded from being able to invest in any type of investment depending on what type of account you have. If a particular crowdfunding platform says that they take IRAs or they say they take retirement plans, they're going to be able to take anything that is listed up here. But again, just remember, you might have heard it from someone on a podcast, your neighbor, your friend, someone at church. It doesn't matter what type of account you have, they can all be used equally for investing in alternative assets. But we need to draw the distinction between them. Why exactly are there so many different types of plans out there? What kind of benefits do they offer, and which one should you choose? Are all great questions that need to be asked by you as the investor before making any type of informed decision on which direction to go. So let's break these down. A traditional IRA is going to be far and away the most common type of retirement plan that people utilize for investing in any capacity. The reason is that most people save for retirement in a tax-deferred fashion. So to give a little bit more context to that, when you participate in, let's say, an employer-sponsored 401k, or you were in the selective service and you have the thrift savings plan, or you worked for the fire station and you had a 457, most all of these types of plans will allow you to contribute in on a pre-tax basis, meaning that you get a deduction for adding money into these types of plans. Which is all well and good. Being able to reduce your taxable liability is typically a good thing. Most people would agree. But again, you are contributing in pre-tax, meaning that everything is going to be deferred until your retirement. So with a traditional IRA, this is the vehicle that most people will roll those funds in from those other employer-sponsored plans after they've terminated employment, changed jobs, X, Y, or Z. Most people will take those funds and roll them into a traditional IRA, which is to being simply the largest type of retirement plan that most people have. And when I say that, I mean the most people having that type of plan. So if you have a traditional IRA, what does it look like from an investment standpoint? Well, if you invest money into any type of investment in a traditional IRA, any of those returns are non-taxable, just like every other plan listed up here. Now, I know people might be thinking, well, wait, the Roth IRA is completely tax-free. And you'd be right from the context of distributions and retirement being completely non-taxable. Any returns that are generated with an investment under any of these types of plans are not taxable at the time of receipt. So in a traditional IRA, if you buy an investment and it returns a certain rate of return, then you sell it for a profit, or whatever happens to that investment trajectory, everything goes back into that IRA completely tax-free. It doesn't flow through to your personal income tax statement. Nothing else needs to be filed by the IRA to the IRS. It's simply non-taxable. Where you have to worry about taxes with these different types of plans are going to be on the deduction that you potentially get going in and the taxes that you potentially have to pay going out. The analogy I like to use for a traditional versus Roth IRA is in a traditional IRA, you've paid no tax on the seed that you plant, and then you pay tax on the fruit that you pick off the tree in retirement. The opposite is true with the Roth IRA, is you pay tax on that seed when you plant it, and you pay no tax when you pick the fruit off that tree. And that general construct holds true for the rest of the plans up here, with two exceptions being the health savings and the education savings account. So again, it really just depends on what kind of money you have and what type of an account as to driving which one of these plans you use. Now with SEP IRAs, simple IRAs, and solo 401ks or qualified retirement plans, these plans are going to be best suited for people that are small business owners, self-employed individuals. They offer a significantly higher contribution limit than your traditional Roth IRAs. Your earnings in any type of plan are going to be unlimited, but you're going to be limited by how much money you can put in on an annual basis to each one of these plans personally. Traditional and Roth IRAs for this year are $6,500 or $7,500 depending on your age, and we get a $500 cost of living adjustment on both of those to $7,000 or $8,000 respectively for the tax year of 2024. Now with SEP IRAs and solo 401ks, your contribution limits can be to the tune of the mid-60s to almost $70,000 per year, but not to get too far into the weeds, it's going to be based on the earnings of the business or your revenues or pay that you have in that business activity. So not everyone can just open one of these and dump a ton of money into it, claim a big tax deduction and go forward. Keep in mind there's a little bit of context to choosing those plans that definitely needs to be explored, either with someone like us here at Advanta or more specifically with a tax advisor or CPA that can properly advise you. And to round this off, you can also use a health savings account or an education savings account to invest in crowdfunding. Again, all of these different types of plans offer great tax incentives to do this, and you're not limited to just what you have specifically being offered to you by your bank or your brokerage as to what you can specifically invest in. You can utilize these to invest in alternative assets. And again, choosing which one is going to is really specifically going to be specific to what you currently have. And keep in mind, if anyone has any questions, please make sure that you do type those into the chat box. We'll be monitoring it as we go along. So moving money into one of these retirement plans. Don't spend too much on this, but again, I get a lot of questions on, hey, well, if I do this type of alternative investment, I have to pay taxes and penalties. It's not the case. It's simply just utilizing a platform that allows for these different types of alternative assets to be held directly in the retirement plan. And the mechanism for moving is either a custodial transfer where the two IRA companies talk to each other, no taxes, no reporting. Now, or if you have an old 401k or retirement plan that was sponsored by an employer, excuse me, doing what's called a direct rollover, where there is some reporting, but again, there are no taxes. There's no 10% penalty due when you move money between two accounts. You don't have to do any of the mandatory withholding that you normally look at when you do a 401k distribution. You can utilize these for just directly transferring money between these two types of accounts to pursue the particular investment that you are looking to acquire. So what are some of your investment options in the context of actually investing into crowdfunding? There's a lot of them out there, and there's more by the day. Now, some of the large high-level ones that you're going to run into are going to be equity-based crowdfunding. And this is going to be more pertinent to companies looking to raise capital. So think about a startup company that is offering shares, or even other types of companies that are structuring or packaging together different type of securities offering. So you can actually buy equity in a particular type of offering. Now, this could be great because you get a potential of the upside. Let's say if the company goes public, or if there is some type of acquisition of the underlying offering, these might be a little bit more geared towards your accredited investor clientele. So maybe not everyone's going to necessarily qualify for them. It might be a little bit more of a walled garden type investment, but the investment structure can certainly trickle down to other different types of offerings. But keep in mind, there's kind of for the company investing, if you will, there's equity-based or debt-based, meaning that you're either going to be buying a chunk of the company like you would on a more publicly traded stock market, which exactly is what common share purchases are, buying a piece of the actual company, or debt-based crowdfunding, where a company is looking to potentially raise capital and they're issuing debt, meaning that your small fraction of the investment is going to be part of a note, and which would offer the benefit of having less equity dilution for the owners and the employees of the company. Again, these two different types of structures are going to be completely dependent on the offering entity itself, not necessarily the investor side of things. And you just need to look at which one's going to really make the best sense for you. Much more common to the moniker of crowdfunding would be things like real estate or real estate debt. Now, these two things, again, kind of play into the more corporate side of things. With real estate, you could actually buy a small fraction of a piece of real estate where there's actually a home, and you may invest $5,000 to own a piece of that home. And those can be structured as master LLCs. They can be structured as limited partnerships, or I've seen them where they stick a whole bunch of people on an actual deed. Now, again, there's not for me to say one way is inherently better or worse than the other, but that is essentially one of the things that is kind of a big keyword with crowdfunding investing, is buying real estate, because real estate's many things, but it's not cheap. So being able to do that in real estate is very powerful. Also, being on the debt side of things, where you can buy parts of mortgage notes, is another very popular option as well. You can also invest in startups. To a lesser degree, syndications can be invested in crowdfunding, although typically those are going to be more of an accredited investor type of investment, not necessarily something for like a Reg A crowd where you don't have to be accredited. And we'll go over what accreditation statuses mean here a little bit later on. And then also private hedge funds can also offer types of crowdfunding for their platforms as well. Again, not as common. Primarily, you're going to see crowdfunding centered around real estate or company fundings, not necessarily larger commercial real estate syndications, although commercial real estate can certainly be offered in a Reg A format. And I've actually hosted several people on our podcast, the Alternative Investing Advantage podcast, that have spoken directly to or offer a Reg A or more crowd-funded style for investing in syndications or real estate debt as well. But these are going to be kind of the main options that are out there for people. Again, crowdfunding is evolving on an almost daily basis, so you might see something new or interesting. Just keep in mind is that the key thing to note here is that if you are amenable to the actual investment, the returns look good, the risk profile is acceptable to you, and they accept IRAs, you can pursue that through an IRA account. And the great thing is that any of those returns are non-taxable until potentially you take out a distribution in retirement, or if it's a Roth IRA, no taxes to ever worry about. So let's move on. So why choose crowdfunding? Real estate prices have basically done a big hockey stick, if you will, since about March of 2020. And before that as well, I recall buying my first house back in 2016. We thought we were getting at the very height of the market, and well, happy that things played out the way they did. But real estate prices have been basically going up and to the right for the past 10 years. We're starting to see market corrections and pullbacks now, but getting into investing in real estate is extremely capital intensive at the moment. And having an option to where you can invest in actual real estate, not some type of REIT, and that's one thing to key distinction here is that crowdfunding is typically not structured as a REIT, a real estate investment trust. It is typically going to be a more granular investment in specific real estate deals, if that makes sense, where you could actually own a piece of a single family home, or you could own an actual chunk of a commercial piece of real estate. It's not a huge package conglomerate of different real estate assets. It's actual specific real estate investments or real estate debt or specific companies that maybe haven't gone public. Again, there's a lot of different ways to frame this, but people choose crowdfunding for a lot of different reasons. And one is the price of the underlying assets. People even do this for highly valued stock, things like Amazon or Google, people who don't necessarily have the means or maybe the want to own something that costs $1,000 a share on the securities market can crowdfund or fractionally invest in certainly securities, but also, again, to the point of real estate being the most popular, at least in my summation and with the self-directed crowd, the price point is really kind of the main driving factor insofar as that you can more widely diversify your funds by investing small chunks over several different properties as opposed to having to have $300,000, $400,000, $500,000, depending on your market, to buy a single family home with a retirement plan. That is getting very cost prohibitive. The amount of people in the United States that have retirement plans that exceed $250,000, $300,000 is precipitously small. That bell curve falls off pretty quickly. So again, price point be what it may, the traditional financing model is very well suited to utilizing crowdfunding. If you're not expecting to use IRA funds soon, some of these different types of crowdfunding platforms can be rather illiquid. So understanding that if you don't have a need for the retirement funds, or if you're looking for a longer term play, because real estate is not a highly liquid asset. It's not highly illiquid, but again, to the point that it's something that's going to be a little bit of a longer term hold is definitely a fair statement. So if you're not looking to utilize your IRA funds for 5 or 10 years, crowdfunding could definitely be a good way for you to get into many different diversified deals for smaller dollar figures that might have a fairly lengthy lifespan. But again, some of these crowdfunding platforms have a higher turnover rate of their underlying investments where they're trying to time market conditions and buy and sell and enter and exit quickly, which again may be of benefit to you, but there's a lot of them out there, so you can kind of choose what works best. Again, with market uncertainty, we have all sorts of stuff going on in the world. We have significant increases in inflation in the United States. We have ongoing military conflicts in Ukraine and Israel. We have so many different things going on that can have direct impacts on our financial markets that it's important to understand that alternatives can offer some bastion to some of this uncertainty in the broader securities markets. Granted, you have to understand that market issues are going to be pervasive no matter where you invest. There can be issues that are born from outside our borders, inside our country, or any number of different factors that can affect any number of different types of investments. But an alternative to actually being in a securities market can be a viable move for some people to help to try to hedge against some of that inflation. And again, pooled investing, or I shouldn't say again, to move forward, pooled investing can be another very interesting concept where it allows for companies to get funds from a larger group of people to be able to buy and sell and enter and exit different deals at a much higher rate to adjust to market conditions. REITs typically move very slowly. If you're investing in single properties at a time, that can be also a very slow and arduous process, because if that property needs a reposition and you're the only one that's financing the reposition of that property, that can take several months to get done. Especially with doing it through an IRA, it can be even a little bit more cumbersome. So being able to have the pooled investment structure where the barrier to entry is significantly less than buying a whole asset outright, whether that be a pricey security, whether that be something like a whole real estate note, whether that be real estate itself. The entire allotment of capital needed to buy into a specific deal being greatly reduced is a very powerful factor that draws people to crowdfunding fairly specifically. So what are some of the benefits and drawbacks of crowdfunding? Not everything is going to be, certainly there's no such thing as a perfect investment. With maybe the exception of winning the lottery, there's no such thing as, risk-free investing. You have to understand what the benefits are. You have to understand what the drawbacks are. So some of the benefits is that you can have a significantly greater variety of investments with crowdfunding. You could have a great variety of not only locations of properties, of types of debt that you might hold with the IRA and the crowdfunding platform, but also the number of deals that you can get exposed to. No matter what type of crowdfunding you're looking to be exposed to with the IRA, you have a wide variety, and no matter which way you frame variety, you have a lot of it. You have the potential for very early stage market entry. Now, if there's a particular company that's looking to develop, whether that is a particular type of IP, whether that's a particular type of real estate, you have the ability to get in, again, at that lower price point in very early stage markets. So again, being able to be a first adopter or a first in for a particular type of investment or market can be incredibly powerful and generate significant returns. Always keep in mind that with being the first also comes risks, so make sure you weigh that. You can utilize more of your capital in a more diverse fashion. So again, very, very good thing to have attached to this type of investing strategy. And companies can find money from outside traditional routes, especially if you are looking to raise capital for a company that, let's say, is has an IP or has some type of sales that they're trying to generate. Being able for the company side of things to raise capital at a higher speed can definitely be beneficial. Granted, most of those are going to be more in the realm of your accredited investor, so your Reg D, not your Reg A type investment offerings. So keep that in mind, is that some of these things don't always apply to all types of crowdfunding. It can be use case specific. You have potential for larger returns. And one thing that people don't realize is simplified tax filings. While this can be a new way of looking at a lot of things for people, especially when it comes to investments outside of a traditional stock market, one thing that is greatly simplified is that since these returns that the IRA is generating underneath of its tax sheltered umbrella don't flow through to you personally, you don't have to worry about any odd tax filings. You aren't claiming any of this income personally. The IRA is typically not filing a tax return. So the investment at the end of the day is just cash in, cash out, and you don't have to worry about doing any type of depreciation schedules, claiming any types of losses personally. It's just strictly the burden of the IRA and nothing flows through to you personally. Now that can be a benefit and that can be a drawback. As I highlighted in red, investment losses in an IRA do not carry over to you personally. So if you invest in something that generates investment losses in the IRA, that's not going to pay out to you personally. Or that's not going to be able to be claimed by you personally. Losses of the IRA are just simply that, losses of the IRA. Some other drawbacks and concerns with investing in this type of fashion and crowdfunding is that you could have liquidity issues. You always need to check. It is very important when investing into any type of crowdfunding platform to check what their redemption or their lockups are. Because if you invest in a crowdfunding platform, they might have a certain lockup that you have to hold that investment for a certain amount of time. And there are limits as defined by Regulation A of the Jobs Act that will more clearly define that. But you have to understand that these are not necessarily liquid assets. You can't just go in and click sell and expect to be in a liquid position there's no such thing as a market order for this kind of thing. So you might have liquidity issues if you're going to be investing into these types of platforms. There's not always a definitive payout date. With things that are publicly traded, especially dividend stocks or let's say bonds that have a coupon attached to them, you have a definitive date of when you're going to get a rate of return paid out by that underlying investment. Now, again, the downside to that is that with things like dividend paying stocks, those dividends are going to be directly correlated to the underlying share price average. So with volatile markets could come a significant swing in your actual cash flow if that's what you're investing for. But again, there's not necessarily a defined schedule of payments. The underlying asset that you've invested in has to have some type of cash flow, especially with real estate. So if the property isn't rented and there's no cash flow, you might not be seeing any returns. Granted, you might be able to get into this for a low barrier to entry cost, but you need to keep in mind that you might not have, an inherent, what's the word I'm looking for? An inherent defined payout date for that. And depending on the type of crowdfunding you're invested in, you might have a dilution of value with subsequent offerings, especially in the private company investing realm for crowdfunding. If they issue additional shares, you might have a dilution of the value of your shares. So you need to keep in mind and really look at the prospectuses and the outlooks and the financial disclosures of these particular crowdfunding platforms to really make sure that you are operating in the best fashion for you, operating in your own best interest. There is a significantly reduced amount of regulation in this space. Now, especially with Regulation A for open crowdfunding where you don't have to be an accredited investor, there is a fairly good degree of oversight from the SEC and from FINRA, but there's not as much as, let's say, you would maybe see in a more traditional financial market such as the New York Stock Exchange or publicly traded securities in the United States. So keep in mind that there's a lot of factors that go into this, and some of the let's call it protection activities that you get from larger governmental organizations don't always apply in every scenario. And especially when you get into the accredited investor stuff, where you have to be qualifying with certain degrees of personal wealth and assets, you might be giving up quite a bit of oversight as well, which could be a benefit, or it could be a drawback to you, depending on what your frame of reference is for that. All right, so now let's look at this from the perspective of some of the rules. So depending on the type of investment that you are going to be pursuing, excuse me, just lost my train of thought a little bit. So depending on the type of investment that you're going to be pursuing, it could be accredited. So it could be something like a Regulation D or Regulation C offering, which doesn't require that the individual be an accredited investor, which generally speaking is that you have certain degrees of household wealth. So household net worth over 1 million, excluding primary residence, income over 250K individually or 300K joint each of the 2 prior years, and a reasonable expectation to the same in the current year. These rules apply to some, but not most crowdfunding platforms. Crowdfunding as a general kind of rule of thumb typically applies to Regulation A offerings, which are an exemption from the Securities Act of 1933, for your Jeopardy questions out there, of the Jobs Act, specifically for companies raising capital. So the barrier to entry and the regulatory oversight is increased for Regulation A offerings as opposed to Regulation D and C offerings under Rules 504 and 506 of the Jobs Act. Now, to kind of simplify that, the stuff that has the lower barrier to entry and the non-accredited investor status investor allowance is going to be a little bit higher regulated, but they're also going to allow more people into them, so the dilution factor might hold true there. So keep that in mind if just looking at these. Typically, crowdfunding moniker is going to refer to Regulation A offerings, but it can also apply to other more walled garden type investments as well. Now, some prohibited transaction rules that you need to understand is that if you are personally related to someone raising capital or that has a crowdfunding platform, you might run into issues with investing in that platform with your IRA. There are rules against investing with what are deemed to be disqualified individuals. Certain exceptions do apply, and if you are going to be investing, not necessarily at arm's length, I would highly recommend that you get an opinion of an attorney. Even if you're investing only $10,000 or $15,000, which you're not going to necessarily walk by on the street if you see that laying there, but in the context of retirement funds, it's not necessarily a large sum of money. It's not insignificant, but maybe not necessarily large when you think about hundreds of thousands of dollars of retirement plan funds, but maybe paying for $500 of an attorney's time to kind of look over and bless the transaction wouldn't be the worst idea in the world. But for the most part, people aren't investing like that. Most of the time when you're investing in a crowdfunding platform, it is going to be at arm's length. But I always like to kind of cover the rules specifically so that way people have as much in their toolbox to kind of, build their retirement as best as possible. So just to kind of delineate who disqualified persons are, they're going to be the IRA owner and the spouse. So if you have a company and you're raising capital using your IRA to invest, even if you are doing it as a qualified crowdfunding under Reg A or Reg D or C of the Jobs Act, could potentially be problematic, not necessarily in a hard black and white case, but there might be some shades of gray. But also, so any lineal descendants or ascendants of you personally. So if you're just listening, it's people directly up and down from you in your family tree. I have a nifty little infographic here that kind of shows everyone that you would potentially have issues with investing with an IRA for. So just keep that in mind, that there could potentially be some issues that arise from investing not at an arm's length transaction. All right, let's look at a case study of how this works. Again, I think most people, if you're coming into this with at least a baseline of this, you might have a general understanding of how this would work, but let's kind of frame it out just so you kind of understand who does what in this whole scenario, and then we'll get y'all out of here. All right, so for this case study, for investing in real estate crowdfunding, Larry has a rollover IRA from a previous job and is looking to invest part of the $250,000 balance. He has business acquaintance with Mike, who is part of a team forming a new real estate crowdfunding company. The company is looking for fractional shares in various real estate projects. So Larry thinks that this is a good idea for him to invest in Mike's new projects. So what happens when? So Larry, in this instance, he needs to open his Advanta IRA account. He requests a transfer from his IRA of $100,000. He reviews the investment prospectus of the new company and decides to purchase $100K of a specific deal. Now, granted, $100,000 into a crowdfunding platform is quite a bit of money. Most people are looking for much smaller investments, and most of these offerings are going to have minimums somewhere around the $500 to $1,000 mark. Some are $5,000, but again, significantly less than this. But examples be what they may, he decides to invest $100,000. He reviews and approves all the offering documents. What does Advanta do? We open the account and submit the transfer request to Larry's other IRA custodian. We ensure proper titling on all subscription and stock issuances if there is such documents related to this. We sign the subscription documents for the IRA and wire the funds for the purchase of the investment, then hold any original certificates or indicia for the actual investment. So what does the strategy look like? Larry holds the fractional real estate shares in his IRA. The investment pays a monthly cash flow percentage based on his initial investment. So that could be range wildly, but typically there's going to be some type of return based on the cash flows of the property. If it is based on rental real estate, if it's based on real estate sales, then it's going to be a percentage of the profits of the sale plus the underlying basis that the client had, and the investment all. But keep in mind, there could be potential. This is, kind of an ideal scenario. Always factor that there can be, and there certainly are risks associated with any type of investment. And with said, that's basically for you here today. Hope we got a high-level understanding of investing in crowdfunding for your IRA. We have great events that come out bi-weekly webinars. So every Tuesday and Thursday, you listen to one on. And we also have our podcast every Wednesday at 10, The Alternative, truly. And then we also have a great networking event for investors that are potentially looking to network and invest with other like-minded individuals. So we hold that the last Friday of each month. This is going to be 1 week earlier because of the Thanksgiving holiday this year. So that is going to be 1 week early for that in November. And if you'd like to register for any of our events, feel free to reach out to us at advantaira.com/events, and you can register right there. If there are any questions, I'll stick around for a little bit to answer those. Again, thank you for joining and have a great day.